What's up, everyone? Hope you've had a great week. If you're short equities, then you probably did not have a great week. But I mean, if you're listening to us, you probably are not short equities. So the Nasdaq absolutely on a tear. ES did catch up a little bit this past week. So we might see it close the gap now that NASDAQ has been in the lead for quite a while here. We actually did notice today on Friday that even the equal weight indexes ended up moving quite a bit more than the regular indexes. So this movement we saw today, it's a broad market movement. We'll see if it lasts more than a day or more than a few days, but that is a very bullish sign, seeing that the move isn't just being generated from a few companies. Let's take a look at what bonds did. We saw a massive rebound in the 10-year futures since the debt ceiling resolution, as we expected. Obviously, Friday, we did have a slight reversal after the jobs numbers are kind of indicating the opposite of what most are thinking of inflation being an issue still. Do you have anything to say about that, Gamma?
Yeah, so the long bond futures, which I have on my screen here, what they're telling you is obvious, right? It's still bearish trend, meaning essentially rates have some upside risk still. We don't believe rates will really soar from here. We're actually in the opposite camp. I've been making a lot of vocal statements about the fact that the bear case for bonds or the bull case for rates is not really lining up with what I'm seeing, and that case is really being formulated from an idea, or I should say, a perspective of having no clue how Treasury auctions work and how the Treasury actually issues debt, and they believe that because we're going to have this surge of issuances, the Fed's going to destroy the long end of the curve in terms of bond value and push yields up because they're going to flood the market, and that's just not how this is going to play out. So,
Well, why isn't it going to play out like that? Like, what is the reason?
well, number one, the bond market. So, what most people don't understand is the bond market's ability to absorb liquidity, right? So, if you go out on any auction, not pick any tenor, you'll notice that there is ample liquidity at each auction, meaning there's more bids than there are bonds available. And this is what's called the bid to cover ratio. I call it the BTC ratio, but don't get that confused with Bitcoin. So it's just bid to cover BTC, right? So the BTC ratio on these bonds, or on these auctions, I'm sorry, is really trending around two, meaning that there are two times the amount of buyers than there are actual bonds. So it doesn't look like, based on the way the Fed has proposed, or excuse me, it doesn't look like the way in the manner the Treasury has put their issuance schedule together that this is going to be an issue for the market. Meaning, there's already ample liquidity sitting at every auction ready to get filled, and the Fed, excuse me, again, I keep saying the Fed, the Treasury um, should be able to issue these bonds, and the bond market and the Treasury market itself should be able to mop up the liquidity without there being an issue. And then another factor in this whole issuance debacle is how the Treasury is going to issue these bonds. Obviously, if they were to, don't get me wrong, the bear case for bonds and bull case for rates makes sense if you told me the Fed, the Treasury, excuse me, is going to issue a close to $1 trillion on one tenor, meaning they're going to just issue $1 trillion on the 10-year Treasury. That would be problematic, especially for duration, right? Because if you're issuing a lot of debt further out on the yield curve, what you're doing is let me simplify this. As you go out on the yield curve, the longer you go out, the more duration risk you have and the closer you get to equity, right? Because in terms of the risk profile, meaning someone that's buying a 30-year bond has a completely different risk profile than someone that's buying a 30-day note or
What
30-day
do you
bill.
mean by equity? As in, like, it's closer to being equivalent to cash?
No, no, it's closer to be equivalent to owning a stock. Or the further you go on the yield curve, because as rates change, for example, you take a 30-day bill, right, or 28-day bill, your value or your risk is not large at all. Even if the Fed cuts rates by 100% on one meeting, right, zero in one meeting, your bill matures in
Right.
28 days.
Right.
But if you own a 30-year bond and the Fed cuts the rates to zero, well, you may have 29 or how many, whatever is left on that duration to play out and hold that bond for. So as you go out further on the yield curve, you're getting closer and closer to a risk profile that would be of owning a stock. But again, even at 30 years on a treasury, you're still leaps away from actually owning a stock. I'm just saying that the risk profile widens the further you go out. So as the Fed goes out on the curve and they issue, or I keep saying the Fed, I'm sorry, guys. As the Treasury goes out in the curve and issues these longer dated bonds, what they're doing is that's where the liquidity pool for actual equities are, right? Like if you're talking about, if you're going to convince let's take the 60-40, for example, right? When you're buying 60-40, 60% stock, 40% bonds, you're buying 40% bonds, not 40% bills. Because you need that duration component in the bond in case there's a recession for the bonds to hedge the losses you would incur on the stock portion of your portfolio. That doesn't happen when you own bills because again, those bills are maturing right away. There's no duration component in there, meaning there's no real appreciation in value of those bills, where you would get that in terms of bonds. So in the case of a 60-40, as bonds go, as stocks go down, historically bonds will go up, hedging that risk. Now that's the arena where this whole liquidity thing becomes an issue out in the curve. Basically, I would argue the line in the sand is at least minimum of 7-year, 10-year or greater. So like anything under 7 years is not that much of an issue. Obviously, there's some duration, but further than that is really where this could be problematic. But as we're seeing from the Treasury schedule, out of the 700 billion that's expected to be issued, 500 is supposed to be in bills. So already, you're talking about 500 billion of the 700 being in little to no duration risk, which means that extra 100 and something billion is really what's going to go out into the area that could quote unquote mop up stock liquidity. Then you have to take the next perspective. How much of it is new money, right? You have to focus on again, if the best way to simplify this is FinTwit is basically a zoo right now in terms of like what's going on, what people are thinking, what they're calling, and it's filled with a bunch of chimps, simps, and like gerbils that think that the Treasury is going to crush the stock market by issuing bonds on the long end of the curve and basically isolating duration and sucking all the money out of the market. When in reality, as I just said, 500 billion of that 700 is expected to be in bills. Now, the remaining value of this whole issuance is going to be a part of this is going to be filled with maturing securities. Every couple of weeks or almost every day, bonds are maturing, right? Or treasury securities, meaning all types of bonds, notes, bills, they're all maturing. And what is a treasury investor, someone that is actively aiming to own treasuries, going to do when that bond bill or I should say bill, note, or bond matures? Well, they're going to simply roll it into the next auction. And the reason for that is they are going to stay with owning. If they're going to own a treasury, you're going to continue to own a treasury. It's considered cash, even on the duration, because at the end of the day, if you own 30-year treasuries, at the end of the day, that matures, you get your dollars back at face value plus interest, right? So, or I should say the interest is accumulated as you own it because it's a bond, but you get my point. There is equatable to cash, right?
Right.
So
So there's just a bunch of liquidity to handle this. It's really not going to cause any liquidity issues.
in my opinion, no. I think that your biggest risk here is going to be most likely um, how the market reacts based on what's going to come in the next stage. So let's go over the calendar and then we'll move onto what that next stage might be.
All right. So next week we have a fairly light week. Monday we've got PMI and ISM. We're going to be looking at those for growth. Wednesday, we've got international trade in goods and services. And then Thursday, of course, we have jobless claims. But other than that, it's a fairly slow week in terms of events.
Okay, so let's go over what the market thinks the Fed's going to do, because again, this is important. Um, the market is really it's really looking like we're not going to see that hike in this month's meeting. And if you remember last week's podcast, I said the market was picking up on odds that we would see the market was pricing in a high probability that we were going to see a hike in the June meeting. And I also added to that I didn't think it's going to actually happen. I thought that it was more of the market going too far in one direction. And sure enough, look at us here a week later, and the odds of the Fed hiking rates in June meeting it went from 70% now to sub 30%. And the way you have to understand the Fed funds futures market is real simple. Focus mainly on the next meeting. You can look at the curve, what we have here. This is showing us the expected Fed funds rate as we go out at each meeting here throughout time and over the next 12 months. But focus on the next meeting and reference the ones following. But the next one's the most important. And when you look at the next meeting, if it is under 50%, it is not going to happen. Meaning, okay, so the odds of a rate hike are 28% or whatnot, not going to happen, right? It only becomes a possibility if you can get above 50%. Then you have to really consider, man, the Fed will likely hike. If it's not, there's no weaseling saying like, oh, the Fed funds futures are dead wrong. Have they been wrong historically? I'm sure every now and then, but we're here for the long game. Law of large numbers. If the odds of the Fed hiking rates is less than 50% at the next meeting, they are not going to hike rates at the next meeting.
Well,
And we've been
what if they want to surprise the markets? Wouldn't this be the perfect time to do it? It's kind of a low risk time to do it, and it would still have that impact. I know
no,
they don't really
no.
need to.
See, I take the opposite approach on that, because there was language removed at the last at the in the minutes at the last meeting, right? Between the minutes and the actual meeting and the Fed press release, there was language removed that basically gave the market the cue that the pause was the most probable. And we had some Fed speakers come out and say some things. Now, obviously, the Fed is going to have to vote. Again, we've gone over this topic so many times in the last year alone. This is not Jerome Powell's decision. He just doesn't wake up on FOMC day like, oh yay, I'm going to hike rates today. That's not really what goes on here. They have to vote on it. It's a board that votes on it, and they agree. They meet. They get the votes they need. They pass it. Some are not all agreeing to it, and some are. What I mean to say is some are maybe more dovish, some are more hawkish. They meet in the middle. They raise what the consensual idea of what the rate hike should be. Then that's what they do. It's not just one person saying, "I'm going to full send it. We're going to hike 50 basis points." And the way the Fed has basically aligned themselves in the last at the last meeting is they prep the markets into pausing. And I'm going to tell you why I think it's probable the Fed will pause. Forget the Fed funds futures market. I think that I've been thinking they're going to pause for a while now. And then I'll go on to what I think is going to happen in the following meeting. So the reason why I think the Fed is going to pause is because about a year ago, if you guys, within the last year, I'm sorry, if you guys have been listening to our content, you would have heard me say that the Fed wants a positive policy environment. And what that basically means is they want the Fed funds futures above the inflation rate. And they have that now, right? Now, they could throw an extra hike on there. But the market's geared up into thinking the Fed's going to pause. They also think the Fed's going to cut rates in the future as we go out through the curve here. They're geared up to think maybe we get one rate hike and then we're going to get subsequent rate cuts throughout the next 4 to 5 meetings. So the Fed has the market on their side in terms of they could hike right now, but they don't have to, because the market essentially could absorb this hike between the June and July odds. It would be absorbed and it wouldn't be that shocking. But they don't need to, because they're already restrictive enough for the current inflationary environment. I know. The zoos, the whole FinTwit community, like I said, they're running a zoo right now. They're going to tell you, oh, core CPI, all this fucking bullshit. You really need to calm down and like look at the problem at hand. Inflation is going down. You can call core all you want. You can dribble drabble. It doesn't mean shit. Okay. Core CPI is a lagging component of CPI. It's of headline CPI. So if you isolate core, and then they do like, the 3-month core change annualized. It's a bunch of bullshit. Don't focus on that. Focus on headline. Market cares about headline. Market doesn't care about core. You'll say the Fed cares about core. In reality, the Fed doesn't even care about that. The Fed cares about what markets think is going to happen, which is why we look at break-even expectations that are priced from the market. More on that in a little bit. But let's get back to the concept here of what's going on. So the Fed can hike, but they don't need to. They're already in a restrictive stance. So if they hike, what they're going to do is they're going to add unnecessary pressure to the fire. And they would hurt equity markets. So this is hiking 25 basis points from here is not going to crush the labor market. Hiking 25 basis points from here wouldn't even really crush the stock market. It's not going to do anything. So why are they going to do it? All it's going to do is put stress on regional banks and whatnot. It's not really, you're not going to, like, it's like the straw, you could claim the straw that broke the camel's back. Like, that's not, 25 basis points isn't going to make or break unemployment at this
point. Right.
So I don't, and the fact the market's already, see, this would be a different scenario if the market was pricing in pauses, but Powell was very consistent with his language. But Powell's language has shifted notably between the last meeting and the last 5 meetings. So in the last meeting, things have shifted substantially to the point where the market I believe the Fed's going to pause because I believe they're at a restrictive policy at the moment. And I believe that the Fed, the Fed's been very vocal about this since the beginning of the year. They said they want to get to about 500 basis points and hold through 2023.
Yeah, it's interesting. They've literally done exactly what they're going to say, what they've said, but it seems like everyone is still so uncertain about what they're going to do. And they've done consistently exactly what they said they were going to do for the past year.
Right. And
but
if
it's that obvious that we're at pause territory, wouldn't we be seeing some more action in bonds?
No, not yet, because bonds themselves are going to see, for bonds to go, you're going to need that growth slowdown. Remember, you're going to need that substantial growth slowdown to accelerate the reason to buy bonds. Growth has been lingering, right? I know we're in a stagflationary regime, so you're thinking, oh, growth is down. Yeah, but like the rate at which growth is down is quite interesting. It's not, I should say, it's not recessionary enough, right?
Right, yeah.
And that is what's holding back bonds. But the thing about growth is, remember the way rate hikes work, they're lagged. So we can expect, the reason the Fed is so adamant about holding rates is they're not stupid. They know that if they just hold rates where they are right now, there'll be a slow restrictive bleed that flows into the economy. And that's exactly what they're trying to do. And they've been very vocal about it, which again is why I'm just telling you what I hear the Fed say is what I'm telling you. They say they're going to hold rates throughout the rest of the year. So they're going to hold rates throughout the rest of the year. It's not that complicated. Now, what can happen? Well, we can actually have an extreme growth slowdown in the process that would force the Fed to cut rates. But let's get back to why the Fed needs to hold rates. They are not sure inflation is over yet, right? Because they're looking at the inflation landscape and they're like, if they cut right now, the last CPI print was, I believe, 4.9%, right? If they cut right now, well, they're in a tricky spot because they can actually reignite inflation if they go too quick, and they'll have to hike again. And this brings me back to my additional point I want to make. There's this whole idea, the skip. The skip is the biggest fucking fairy tale I've heard in a minute. They're gonna skip one meeting and hike the next meeting. Like, well, what do you think this is?
Well,
you think
that's in the same that's the same thing as if they just hiked right now too. It just doesn't do anything.
Right, but like, what do you think this is? Is like the lottery? Like one day you're up, the next day you're out. Like the Fed's just going to show up and say we're going to skip, hike, skip. You know what type of uncertainty that adds to the market? Because if you start playing that skip, hike, skip game, well, what happens at next meeting when they hike? If they skip now, then are they going to skip and hike? Because the Fed's not known to make irrational decisions like that.
Right.
And I've
That
said
would
this,
just seem like they don't know what they're doing if they did that.
yeah, yeah, and I've been very vocal about this as well. The Fed is the contractor that shows up to hang a picture with a sledgehammer. Okay, they just beat the nail in. They'll blow the whole wall out trying to put the picture up. They really will. And like they should have been hiking rates a lot quicker than they did. A lot sooner, I should say, than they did. Then they wouldn't have to do it as quick. But they didn't. They let market inflation expectations run amok, and they just sat there and said, "Oh, you know, still QE. It's not the time yet." And what ended up happening was we had this inflation issue. But the Fed was able to act quicker than most other countries, and that helped the dollar gain value over all these other currencies, because what the Fed was doing was the Fed was the earliest, latest actor in the game. As stupid as that sounds, they were the ones that they were. Everyone was late, but the Fed was the earliest late one, and that's why the dollar did what it did. But let's get back into what's going to what's going to happen with this whole like if the Fed holds rates and whatnot. What should happen? Well, let's go over bonds and stocks, because everyone's so confused. Everyone's looking at bonds. They're wondering, when is the bond trade? Because everyone knows rates won't stay up at these levels forever. Everyone also knows that growth will slow at some point, and bonds are extremely discounted. So there should be some ample opportunity in the bond space. The problem is stocks are ripping. So everyone's like, oh, every day stocks go up every week stocks do what they did this week. If they do this every week, you start to chip away at people with FOMO. And FOMO is basically just another way. FOMO is the fear of missing out, but it's just another way of people to trade and invest because they don't know what they're doing. If you know what you're doing, you don't get FOMO, because it doesn't matter, right? Whatever the spoos tell me, it does not matter, because there's no reason to have FOMO, right? The only reason you have FOMO is you're uncertain about missing out. So you take unjust actions that end up actually hurting you most of the time. But if you understand the playing field, then you know what every pocket or what every angle of the field is going to yield in terms of shots and results. You know it doesn't make sense to capitulate yourself into I should say, an immature position, right? So let's look at what this chart is showing you. This is going back to 2018, and this goes back to the market radar thesis on what we think is going to happen. We've been saying this for months now, and it's been slowly playing out. Bonds, not so much, but the stock part is well been proven right there. So, what is this chart showing you? So, if we take a look at the end of 2018, if you remember back then, the market was dismantled on the idea that the Fed hiking rates. And the idea was that Powell was going to slow growth down substantially in the attempt to battle concerns of upcoming inflation, possible inflation that could get out of control. Now, what happened was both stocks and bonds went down because the Fed was hiking rates, and that in turn draws down bond values, and stocks don't like it when the Fed's hiking rates, especially when there's no inflation, right? Or inflation is minimal.
Right. So
And
that was deflationary.
up until, yes, it was deflationary up until the point. But where I'm getting at it is both stocks and bonds basically went down because the Fed decided to hike rates. And it really wasn't a growth problem at this point in time. It wasn't so growth driven, right? It was more of Fed policy driven. You have to understand these nuances because they're very important. If this move was more driven on Fed policy, well, what happens when the Fed unwinds their policy? Well, then the move is reversed, right? So, for example, if I'm the Fed and I hike rates X percent, and stocks and bonds both fall because I'm aggressively hiking rates, well, if I cut rates from X percent lower, well, then stocks and bonds should revert, unless I've destroyed the economy in the process. And that's exactly what happened in 2018, the end of 2018. All of a sudden, we go into this new bull market in equities and bonds. Now, most people are so baffled. They shove equities draw down 30%. Oh, we're going to go lower. You get the bear crew that comes out every time the market's down, cheering for lower prices on the lows. That's how this works. But Aries goes ahead and Aries longs bonds on December 13th of 2018, this white line here. That's when Aries goes long bonds. Now, as you can see, stocks actually go up as well with bonds. Bonds being in white and stocks being in orange. The SPY and TLT, they both rise together. Why is that? And this goes to the point that I'm going to make, and I've been very clear about this. The recession, there was a deflationary period here where bonds actually excelled, but it wasn't deep enough. Remember where you are on the regime chart. If you look on your, if you visualize this in your head, look on your left, you have expansion where growth is up, inflation is down. On your left, on the bottom, you have deflation where both growth and inflation are down. If you have growth up, or not up as much, maybe down just an inch, but you have inflation down a lot, you are flirting with the line of risk on and risk off. So what ends up happening is you can reside in the middle there, basically in the woods, where you're not getting slaughtered because it's not a real recession, but inflation is coming down and you're getting this positive bond stock correlation to the upside. Now, where I go with this is back to where we are today. We've seen stocks pretty much rocket off the lows, and bonds have been trending sideways. Again, look at bonds. Bonds have not made new lows since November of 2022, and they're actually making higher lows subsequently. We'll see how this plays out. The trend is still bearish, but what's going on here is the market's realizing that we're not really in this negative growth environment, and which the market thought we were going to go into when both stocks and bonds were on the lows because the Fed was hiking rates, and the market thought, oh, this is going to cause a recession. We're hiking the fastest we've ever pretty much hiked in terms of the Fed policy. This is going to basically break the markets, and in the process with the Fed hiking rates is going to destroy the bond market. And that didn't happen. Obviously, we are not in a recession, and we are nowhere near to where the market thought we would be last year when the SPOOs were on the lows, when the long bonds were on the lows. That's why stocks have recovered so much. Now, bonds, on the other hand, they're not up as much, but they're still not making new lows. And again, primary reason is rates aren't expected to go that high. Inflation's no longer the issue that it was believed to be at the time, and growth is holding on basically by an inch, where stocks are able to facilitate this almost quasi risk on environment. Like I said back here in 2018, it's not really risk on, but you're right on the border. And what ends up happening is both can move up at the same time. And this is going to confuse a lot of people. I've been very clear on this part because most people are trained on one of two things: 60-40, just buy bonds and buy stock and just ride it out, or buy stock in economic booms and buy bonds in economic busts. They have no idea that both of these can go up at the same time. Typically, in an environment like this, again, they're not frequent, so it's hard to gauge. But typically, in an environment like this, bonds outperform stock in a volatility adjusted basis, meaning when you have to account for drawdowns that you're going to take on the bond positions, they're typically better than that in terms in terms of owning stock. And we could just look at the chart right here. Up until before COVID hit, it was more ripping and baselining, but outside of some volatility here in 19, and then we ripped again into COVID. But where stocks had more aggressive drawdowns along the way, and again, just saying risk adjusted returns, they were better in bonds, and that's because we were in a risk off regime. So with what we have now and where we are right now, understand that just because stocks are going up, it doesn't mean that we're not in a risk off regime. It doesn't mean that the bonds are not going to ever work. It doesn't mean that you're in the clear even, because what ends up happening is you get so focused on where stocks are going on a daily basis, and you're so focused on SPY or the Qs, and you forget that in a risk off regime, VIX can easily get to like 25 if it wants to in a couple of days. And I'm not saying that you should be betting for this, because we don't short bullish trends. We're not going to short any of these indices that are bullish. But like NQ can easily go down 7% to lower VAMP. That's perfectly fine in a straight line. That's perfectly fine. But like that type of volatility is what people tend to forget when markets are doing this. A lot of people are saying, "Oh, the bear market's over. Stocks should just go up from here." But that's not the case. So I think you need to keep a clear head, focus on the regime that's in front of you. Don't try and trade a regime that does not exist at the moment, and manage the game over the long term. Aries will, or Aries has made up for any lacks of performance. We'll see how it does this time. I'm confident that Aries will be able to manage the situation rather well as it has throughout the past 12 months. I think the next 12 months will be good for us too. So thank you guys so much for listening to this week's podcast. If you have any questions, feel free to reach out to us on Twitter at The Market Radar.